Hello, everyone. Thank you for joining us for today's webinar on mastering compliance in digital assets through multi-tiered defense strategies. We believe this topic is not only current but crucial in navigating how to understand the perceived complexities of digital assets. My name is Ruth, and I'm an associate at the Institute of Financial Integrity. Here at IFI, we work to empower the professional community in protecting the global financial system through cutting edge research, education, and training. And we're happy to see everyone joining us from all over the world today. So, good morning, good afternoon, and good evening, everyone. We really appreciate you taking time out of your day to join us today for this discussion. And we hope that you gain some value through the discussion we'll be having today. Before we begin, I'd like to cover a few housekeeping items. Please note that today's webinar is being recorded, so we'll be sure to share the link with you to revisit or share with your colleagues after the event is complete. We also encourage your comments and questions. You'll see a Q&A tab on screen in the console on the right-hand side. Please feel free to submit questions throughout the webinar for us to address during today's session. And after the conclusion of today's event, you'll receive a follow-up email, including the link to the webinar recording, as well as other information for further reading. And now I'd like to introduce you to our panel of industry experts. With us today, we have Elizabeth Sevrinovskaya. She's a managing director at K2 Integrity, where she leads the virtual assets compliance advisory practice, advising a broad range of crypto ecosystem participants, including the large exchanges and issuers, NFT marketplaces, protocols, and startup Web3 companies. Prior to joining K2 Integrity, Elizabeth held a variety of consulting and in-house roles, including compliance partnerships at Coinbase and risk policy at Stripe. Elizabeth specializes in building an effective implementation of financial crimes compliance programs, as well as regulatory risk management for entities navigating regulatory examinations and enforcement actions. She started her career in traditional finance, where she led financial crimes compliance program remediation efforts for a large foreign correspondent bank. Elizabeth holds a master's in global affairs and a JD from the University of Toronto, during which time she advised the Egmont Group of Financial Intelligence Units and interned with several leading UN-affiliated international organizations, including the Coalition for the International Criminal Court. We also have with us Andrew Rosenberg. He's a senior director of global compliance at Ripple, overseeing the global financial crimes compliance program across Ripple's corporate structure, including multiple MSB registered entities, one of which maintains a BIT license with the New York Department of Financial Services. Andrew's responsibilities include policies and procedures, regulatory and audit examinations, technology and data, as well as providing advisory support to product and business teams. Prior to joining Ripple 2.5 years ago, Andrew spent 7 years at PwC advising traditional financial institutions on their financial crimes programs. And finally, we have with us Catherine Woods. She's an associate managing director at IFI. She has more than 15 years of experience in financial services and fintech, as well as prior service in government. Her focus areas include digital assets, export controls, and proliferation finance, along with anti-money laundering and countering financing of terrorism. Prior to IFI, Catherine was the first hire made by a corporate-backed digital asset brokerage and exchange, successfully building the KYC function and securing regulatory approval. While working at Standard Chartered, Catherine provided specialist input to build the bank's framework to manage financial crime compliance risks for digital assets, and led an internal working group on central bank digital currencies and stablecoins. Catherine's career also includes working as a financial crime investigator and an external liaison. Her achievements include leading intelligence sharing public-private partnerships, speaking at Interpol, the Royal United Services Institute, think tank on innovation in financial services and industry and client events, as well as also enabling investigative capability development in countries around the world. She's a qualified JD and holds certified anti-money laundering and blockchain certifications. Thank you once again to our speakers we really appreciate your time, and we're really looking forward to the wealth of experience you'll be bringing to today's discussion. So we are going to begin with a crucial aspect that underpins many compliance frameworks. So our first question today is, to what extent does the three lines model apply for digital assets compliance? Catherine, could you kick us off with your insights on this question?
Yeah, absolutely. Thank you so much, Ruth, for the question. To recap very briefly on what the three lines of defense are, we'll start with the second line. So the second line is typically the risk or compliance functions. They set out what needs to be done. So things like what makes a client high risk, what are the KYC or CDD requirements that need to be fulfilled, and they put that kind of policy and standards together, drawing on both the directions from the board, but also on external regulatory requirements. The first line function then includes teams like sales, relationship managers. They own the risk, and they're responsible for working out how to implement the requirements set by the second line. So that might be things like the systems that they're going to use to do KYC, the templates that they're going to use to collect the required information. And then, of course, we have the third line, which is audit, that's providing assurance. So circling back to the question, the three lines model definitely does apply to digital assets, but it may need a little bit of adaptation. So the benefit of the three lines model is that it provides like a segregation and a level of independence particularly between the first and second line, and also with the third line. But digital assets is an emerging area. So what that means is that skills are in demand and can sometimes be scarce. And there's a much closer linkage between commercial and compliance decision making. So that means very close collaboration is needed between those first and second lines. That is not, a lot of firms are already doing this. So this is not to say this is a new concept, but it is something that is particularly relevant in digital assets. So let me give a couple of examples of that. So a firm like a financial institution that is making a decision about how to engage in this digital asset space, there's a number of different ways that they could do that. The first one will be to directly offer the ability to trade in digital assets itself. So that's a very direct exposure. The next one might be they might want to offer their traditional banking services to clients in the crypto industry. So that might be offering traditional banking, but the clients are crypto firms like hedge funds or brokerages or exchanges. And the third way that they might get exposure, whether intentionally or not, is if their existing customers are using their banking services to enable crypto transactions. So, for example, a retail banking customer makes a wire transfer to a brokerage or an exchange, and they're going to trade digital assets using that exchange. The decisions that are made around which of those services are accepted have some quite significant implications for compliance as well. So as an example, if a firm decides to offer services to crypto native businesses, typically they're rated as higher risk. So what that would mean is the second line functions, so the compliance functions, as well as some of the first line functions, would need greater levels of resource. They will need to do enhanced due diligence. They will need to do more frequent, regular reviews, and they may need enhanced tools and investigative capability in the second line. Not all digital assets are equal, and this also influences the decisions that need to be made jointly or in collaboration between the first and second line. So as an example, if we take three different types of digital assets, stablecoin, so an asset-backed stablecoin, backed by fiat currency, so traditional cash held in a bank account or cash equivalents, may be seen as a lower risk type of digital asset, typically used for payments. In the middle, we might have a decentralized asset like Bitcoin, quite well established, but decentralized. And on the other end of the spectrum, something that's much higher risk, like a privacy coin, where it is designed to be as untraceable as possible, which I think we'd agree would be high risk or perhaps even should be prohibited. So these are some of the decisions that need to be made between the first and second line, because there are implications for the bank's risk profile and for the resourcing of both of those lines. And what is really critical here is building the capability to make these kinds of informed decisions. So we've seen a few examples of how not all digital assets are equal. but in an area which is unfamiliar. And I think we're still seeing knowledge of digital assets developing. Where an area is unfamiliar, risk can often be perceived to be higher. So that's a lack of proportionality between real risk and actual risk. And I'll provide one example of this before welcoming views from my co-panelists on this topic as well. So as an example, the Reserve Bank of Australia estimates that 10% of banknotes in circulation are used within the shadow economy. Now, the shadow economy means either being used to purchase illicit goods and services, to store the money or the proceeds made from doing that, or to be used to avoid paying taxes that are due. So that's 10% of banknotes in Australia are used for these illicit purposes in the shadow economy. In contrast with that, blockchain firms estimate that less than 1% of on-chain transactions are illicit. There's a few caveats around that, of course, because that's only on-chain activity, and there can be other ways of transferring crypto. And obviously that's based on analysis, so it's not going to be 100% accurate. But I think we might agree that 10% of traditional banknotes versus 1% of crypto transactions being illicit is perhaps the opposite way around than some might expect. So to recap on all of that, the 3 lines of defense model definitely applies, but I think there does need to be greater collaboration and consultation between the 3 lines, and the backing behind that is to have the capability to make some of these important decisions in some areas that are still quite complex.
Thank you, Catherine. Andrew, would you like to share your thoughts on this question as well?
Sure. First, I'll start out by just thanking the Institute for Financial Integrity for having me. It's great to be here with all of you. And also a quick plug, the opinions I share today are my own and are not those of Ripple. But getting back to the question, so, very much agree with everything that Catherine said. I think this model has become an expectation from regulators who oversee regulated businesses. They're not necessarily looking at this differently than they do for traditional finance. And while there's more flexibility, perhaps for unregulated digital asset businesses, I still think this is a good model to follow. And then the other thing I would add, regardless of where certain functions sit, such as onboarding, I think it's important to have a model where the business acts as the risk owner, compliance is the risk advisor, and audit acts as the risk checkers. And so recognizing that startups and other maturing organizations may not be able to employ this model at the outset due to a smaller number of full-time employees or people dual hatting. I think it's important to move in that direction because you want to avoid potential conflicts of interest between business goals and regulatory requirements. And then because of that in the digital asset business, with businesses that may not be as mature, not everyone may come from a traditional financial background, financial services background. And I think educating the first line on what it means to be a risk owner and how business decisions can impact the organization are really important because the second line is kind of setting what those standards are. And you want the first line to own that and make decisions that are in the best interest of the organization.
Thank you, Andrew. Elizabeth, would you like to share your thoughts as well?
Sure, and I think I'll be brief because the 2 other panelists took the words out of my mouth. I absolutely agree that the model does apply in the context of digital assets. It is 100% a regulatory expectation if you are a centralized regulated entity. And it's also becoming an industry standard. So for the mature clients that we advise, we're seeing, a lot of their senior leadership is coming from traditional finance. They're employing a lot of the same frameworks that you have in the TradFi space when it comes to the 3 lines of defense. We've even had clients explicitly state in their financial crimes compliance policies that we follow a 3 lines of defense model. So a lot of what the prior panelists have said is very true today. One thing that I want to sort of bring to the fold here is what we're seeing from regulators in terms of feedback. So even where a firm employs that 3 lines of defense model, I've still seen MRIAs and MRAs where there's risk management failures that are being called out, even in these firms that are ostensibly applying the model. So things like ineffective separation of duties often comes up as an area of concern, or undue influence from the first line on the second line. That's still a big challenge. And I think, Andrew and Catherine both touched on this. The issue in the crypto space is, we're often looking to move very quickly. We're looking to roll out new products and services. And there needs to be some reasoned analysis of what the risk is associated with that. And that can become really tricky if, product has an outsized voice in those discussions and compliance isn't brought to the table to opine early on before the product is launched, not after the fact. So these are the types of things that regulators are particularly attuned to, and they will call out firms for this. And these things will be cited in either MRAs or enforcement actions. And then I think Andrew raises a great point, which is that it is trickier in the context of decentralized entities or infrastructure firms that are not financially regulated. But I think if you think about this as an effective framework for risk management, which is ultimately what it's meant to be, it's meant to be a framework to guide decision making. A lot of those same principles apply or ought to apply. And I'm not talking just about financial crimes at this point, but other areas of compliance and also things like cybersecurity. It's good to have that separation of duties. It's great to have dual controls, especially when you're thinking about things like custody. And of course, that regular testing of controls through third-party audits. Even in completely decentralized projects, right, we see code audits as being an expectation and an industry standard. So I think that even if you use the framework somewhat loosely, it applies across all aspects of digital assets.
Thank you, Elizabeth. Catherine, would you like to add anything else?
Yeah, I think some really great insights from our panelists here, and I think that's a great point, Elizabeth, that the principles of the 3 lines can be applied more broadly than just the the traditional settings where we would think of doing that. I want to circle back to one of Andrew's points on the responsibilities of the first line, and I think he's absolutely right. The first line owns the risk, and I think the advantage of that close collaboration between the first and second line is that it can result in some really positive outcomes for clients and for the business as well. So an example would be if the first line is interacting more directly with clients, perhaps at a smaller firm, there's an opportunity and a need for them to roll their sleeves up and really understand the implications of some of the clients that they're bringing on board. So, for example, if they're in discussions with a few different clients, understanding that a regulated financial institution client presents a much lower risk compared to an unregulated trust in the Cayman Islands or something like that, can be really valuable for them to understand what the downstream implications of that are. And that close collaboration is a way of building that understanding. So if you have finite resource in your KYC or your compliance teams, if you focus your business development around, say, lower risk entities, you'll get more throughput. You'll get more clients on board and generating revenue faster than if they are much higher risk entities where you need to do enhanced due diligence on all of them. And I think there's scope for the second line to really help their first line colleagues as well. So if a traditional client base, perhaps of a bank or some other type of financial institution, are often familiar with due diligence requirements. So you need to provide lots of documents. You might need to provide, financial records, a bunch of other things. If you are dealing with those types of entities who haven't dealt with the regulated financial sector before, they may often push back and say, why are you asking me for all of this? I've never been asked for all of these documents before. And I think the second line can then have a really valuable role to play in preparing that first line to answer those kinds of questions. So to be able to explain why the KYC documents are required, this is an aspect of regulated financial institutions. You gain reliable access to the financial system and to bank accounts. So I think there are responsibilities and there are advantages of that close collaboration between the first and second line.
Catherine. We already have questions coming in. Okay, but I think we'll wait till the Q&A session to take the questions. But thank you all so much for your insights. So we'll be moving on to the second question, which is, what can we learn from recent enforcement actions within the digital asset sector? Elizabeth, would you like to share your thoughts on this?
Sure. Oh boy, this is a big one. So I'll start with the biggest takeaway that we see from recent enforcement actions. And it's funny because I think, there's nothing surprising here. It's just like the traditional finance enforcement actions from 10 years ago. It's where a firm knowingly and willfully violates regulation, the penalties are going to be much higher. And we saw this, of course, with the Binance $4.3 billion settlement and the five-year monitorship. In that case, there were a lot of things that were explicitly called out as Binance knowingly doing certain activities or undertaking certain activities that they knew could put them in regulatory crosshairs, and then choosing to, for business decisions, going ahead with that activity. That is obviously something that regulators are going to look down upon, and that's going to result in heightened enforcement actions. Conversely, where a firm takes responsibility for their actions, provides timely and voluntary disclosures to regulators, and proactively undertakes remedial action, that firm is obviously going to be in a better position with its regulators, even if they still face a monetary penalty. So looking at a contrasting example, in the case of Coinbase in January 2023, in that consent order, despite the deficiencies that were cited, the DFS also cited several mitigating factors, including Coinbase's cooperation with the department, and they also gave the firm credit for undertaking extensive remediation efforts, including its investments in building out an appropriate compliance team and its investments in its transaction monitoring and customer risk rating tech stack. So that actually enabled Coinbase to reinvest half of what would have been otherwise a monetary penalty, $50 million, into further enhancing its compliance program. So we see different tacks that a regulator might take depending on the level of remediation that's being undertaken. And then several key themes that we're seeing in recent enforcement actions, depending on the regulator, is looking at the DFS, for example, whether it's Gemini, Coinbase, or even what we're hearing behind the scenes from our clients that are currently going through examinations, is this attuned focus on VPN as part of effective risk management. This is something that is a big focus for the DFS right now. So making sure that if customers or transactions include, signs of use of a virtual private network, VPN, that in those cases that is taken into consideration as part of the customer risk rating, that there are controls in place to identify improbable logins, that type of thing. And that, I think, is a unique focus of the DFS more so than other regulatory agencies. And then a couple more themes coming out of the DFS. So, for example, for Gemini, Genesis, BitPay, Coinbase, we see a heavy focus on the need for an effective understanding and ongoing monitoring of customer risk. And this is one of the areas that's typically the most challenging to implement, making sure that you have an effective risk-based customer risk program, depending on your customer types, and also taking into account the level of automation that exists in this space is always a bit of an area of tension. And then we also see in these enforcement actions, especially for DFS, a big focus on DFS Part 504. So the expectation that DFS regulated firms are adhering to Part 504 requirements for maintaining effective transaction monitoring and sanctions filtering programs. This is another area of major focus. And this is also something where I think historically, and the tides have changed, but I think a couple years ago, a lot of virtual currency firms weren't even sure that DFS Part 504 applied to them. Now it's very clear that it does, and those expectations are that they go through an annual certification process, that they ensure that they have effective transaction monitoring and filtering programs, and also that certification process is audited. These are areas that are oftentimes a thematic concern for the DFS. So definitely worth stating for any of those firms that are DFS regulated. And then on the OFAC side, there's a very consistent theme that we see, whether it's Poloniex, Kraken, Bittrex, BitPay, BitGo. I'm citing all of these names because it's a consistent theme throughout. And it's this idea of the reason to know. So if a firm knew or ought to have known based on IP signals, geolocation data, email addresses, or any kind of KYC details that users are based in comprehensively sanctioned jurisdictions, it's OFAC's expectation that this activity will be blocked, that it will be actioned. And even in the case of BitGo, this information was being collected actually as a different part of their program. It wasn't collected as part of their FCC program. But at the same time, if the information is available, OFAC's expectation is that there is a reason to know that that information is being acted upon. So it's really incumbent on compliance leaders to know what information is being collected throughout the enterprise, and then using that information as part of their risk management activity. And that can be actually incredibly tricky. So really important to call out, really important to think about, especially in the context of sanctions being a strict liability regime.
Thank you, Elizabeth. Andrew, would you like to add anything to this question?
Sure. I think everything Elizabeth said is very much on point, and particularly to start with the fact that the same themes that we saw 10 years ago in TradFi we're still seeing today. I think one of the biggest ones for me is the importance of controls growing at the same pace of the business. And I think that's one of the biggest challenges for startups who go through rapid growth, is to ensure that their controls are keeping up with their business. I think some of the things that you see as a result of not having that are things like inadequate staffing that has been called out by the regulators continuously. Manual monitoring for transaction monitoring. While this is not necessarily a bad thing when you first start out, I will say the regulators will almost certainly start to be critical of manual processes when your volumes reach a certain level. And if you don't have proper staffing and you have manual processes, what can happen is backlogs. And that's certainly something that is bound to get you in trouble. And so keeping pace with the number of transaction monitoring alerts, sanctions alerts, KYC ongoing reviews, right? This is all really important and really table stakes for the regulators to pick at if you're not kind of doing the basic, what I call blocking and tackling for compliance. One other one that I'd call out that I saw, in the enforcement actions that Elizabeth referenced, is just the importance of good governance. These are things like board oversight, documented appointment of your BSA officer, formalized reporting and to the board, and then Elizabeth mentioned cooperation and how that can make a huge difference. Just making sure that you're being responsive to your regulators and following kind of the guidance that you're being provided can go a long way. Even if you do get in trouble, to reducing the potential penalty at the end of the day. So again, a lot of the same themes that we've been seeing over the years in TradFi are now the digital asset sector is having to deal with as well.
Thank you, Andrew. Catherine, any thoughts?
Yeah, so I think Elizabeth highlighted some of the really high-profile enforcement actions, and the ones that we see the biggest headlines around tend to be like the US regulators, so the DOJ, CFTC, SEC, and some might raise the question, well, what is everyone else doing, in other countries around the world? So I think it's worth briefly looking at some of the activity in other countries. And I think the first part of the response to that is that quite often those regulatory actions by US regulators are being supported by other countries. So, for example, Singapore supported the CFTC's investigation into Binance, and a Canadian regulatory investigation into another entity, Femex. So, in some cases, the non-US regulators might not be headlining, but they are supporting in the background. We've also recently seen the UK regulator, so the Financial Conduct Authority, being part of or initiating, along with the Metropolitan Police, a criminal investigation into a crypto asset exchange, which is operating, or which was said to be operating without a license. This happened in June this year, so very recent. 2 individuals were arrested over suspicion of running an illegal crypto asset exchange, and that involved more than a billion in unregistered transactions. So we are seeing actions being taken in other countries as well. In some jurisdictions, there's also quite a focus on licensing, perhaps as a way of achieving those same policy objectives, or consumer type warning. So in Hong Kong, for example, the Securities and Futures Commission issues consumer warnings on suspicious exchanges or suspicious investment products. We've seen Europe being very much focused around their new regulations, so MiCA. And we've seen Germany's BaFin as well refusing Binance's application for a custody license, and that was later withdrawn. So the enforcement actions that we see tend to be US regulatory. They're the headline, with support from other countries. And then in other jurisdictions, licensing, consumer warnings, and other methods are used to support those policy objectives.
Thank you. Thank you all so much for your insights on this question. So we'll be moving on to our final question for today, which is, what emerging trends pose the greatest challenges to digital assets compliance? Andrew, could you share your thoughts on this question?
Sure. So there are probably too many to count, but I'm going to start with 3. One, I was at a roundtable with Elizabeth just the other day, and this is one that pretty much everyone mentioned, was around the travel rule. And there's just, the industry really needs to coalesce around a standard, because right now there are multiple different solutions. They support different digital assets, and it just makes it hard to comply when everyone's using a different method of compliance, right? And so this is one that is going to be a challenge until the industry can determine kind of what the appropriate standard should be. The second one, I think, is kind of the expanding definition of money transmission, and this is particularly, in the United States. We've gone from where money transmission consisted of moving funds to how whether you have control over the protocol, which is then creating compliance obligations for a whole new set of companies. And I think the kind of global regulatory disparity provides incentives for businesses to operate in frameworks that have clear regulatory frameworks, such as Europe, Dubai, Singapore, which then means that developers, investors are going to flock to those jurisdictions, and the US is going to be left behind. And so that's certainly one challenge. And then lastly, I'd also mention solving for digital identity. I know this is a big topic, where you want to allow users to obtain services while being able to keep their private information private, but at the same time also having safeguards to prevent use by second parties or other bad actors, and kind of that dichotomy between kind of those two purist ideals of privacy and security, and how we merge the two to get to the ideal solution. So those are just 3 that kind of come to mind for me.
Thank you, Andrew. Elizabeth, would you like to share your thoughts on this question?
Sure, and Andrew stole one of mine, because I also was going to baseline on the industry roundtable. But I think, I really focused on 2 themes, and they're really not emerging trends. These are issues that have been consistent themes and challenges, basically since the beginning for virtual asset firms, and I think continue to be challenges for virtual asset firms. So, Andrew already touched on travel rules. So just picking up that theme for 1 second. the biggest issue, I think, with travel rule, as Andrew said, is just this fact that we don't have an interoperable solution. Everyone sort of has multiple solutions that they're working with. And FATF has issued an update earlier this month, actually saying that while around 70% of respondents, which unclear how many jurisdictions that actually amounts to, but 70% of respondents have passed travel rule regulation, enforcement efforts around this are still low. And what this means is that fundamentally, depending on the jurisdiction, you might not actually be all that incentivized to comply with the travel rule. And one of the things, that we covered during the roundtable is that the U.S. is not necessarily the most advanced when it comes to travel rule enforcement. There are certain jurisdictions that are further ahead of us, but there's still a significant number of challenges. And then there's also a question of, to what extent can you actually penalize any given entity for lack of travel rule compliance when the whole point of this, rule is that it's meant to be, we're all in this together, we're all sharing information back and forth. If a lot of your counterparties cannot provide you with information because they either don't have something in place or because they're unwilling to, how do you as a compliant actor, deal with that? Do you then just reject those transactions, especially if those are particularly large counterparties? I mean, these are major challenges for the industry, and I just don't see them going away anytime soon. But the biggest challenge that I think we all aligned on at the roundtable, and this is just sort of what we're seeing across the board, is obviously sanctions and sanctions compliance, sanctions evasion. And the concern here is really the sophistication of the bad actors and the speed at which they leverage technology to launder funds and commit sanctions evasion. And the concern is also that as sanctions programs continue to evolve, become more complicated, more stringent, and as the US, EU, UK continue to target particular countries and regimes, we'll continue to see an increased interest in crypto as an alternative payment method and as a vehicle for sanctions evasion for countries like Russia, North Korea. And with focusing on North Korea for a minute, according to the UN Security Council expert panel, DPRK state-sponsored groups have stolen an estimated $3 billion worth of cryptocurrency since 2017 from their various hacking efforts. And at least 50% of this is used to fund weapons programs, so nuclear weapons programs. So from a proliferation financing standpoint, that's incredibly concerning. And when you couple this with the fact that groups like Lazarus Group are especially prolific at hacks and at sophisticated money laundering techniques, at sophisticated sanctions evasion techniques on chain, things like cross-chain hopping, use of DEXs, use of OTCs, use of stable coins very quickly to move funds in and out. All of this is incredibly concerning, and it requires significant, essentially, efforts by many parties, whether it's centralized parties or even somewhat decentralized providers that might be able to put in things like geo-blocking controls. We're all in this together to try to fight that type of activity. It's particularly concerning. And the last thing I want to state on this point is that we also have to be mindful that this year, the UN Security Council did not extend the mandate for the DPRK panel, which monitors sort of North Korea's proliferation finance activities. And this is one of the avenues through which we get this type of information. So we might have less of a line of sight into DPRK state-sponsored hacking groups going forward. And that's of significant concern specifically to the crypto industry because it has been such a victim of it in the past.
Thank you, Elizabeth. Catherine, would you like to add any comments to this question?
So I think Andrew and Elizabeth have provided really comprehensive responses. There's just probably a few additional points that I would add. I think the regulatory fragmentation and complexity, both globally and even within jurisdictions, is one of the significant challenges. And the reason for that is because it makes compliance much more complicated. The level of resource required to make sure those requirements are being met for different products and different services, is something considered a security token, or is it not considered a security token? I think that that consumes quite significant resource, which is absolutely necessary. Meeting those regulatory requirements is absolutely critical. But I think it also provides gaps, and businesses who don't want to have the required internal governance. We've seen some really significant failures that demonstrate this. So if they don't have the required governance, they're not putting the required controls in place. A fragmented global regulatory environment provides corners where they can operate. And where criminal elements can operate and those kinds of things as well. So I think progress is slow, as Elizabeth mentioned. The FATF recent report on progress with implementation of the virtual assets requirements has not moved too far since the previous year, but I think that the regulatory consistency and alignment would be immensely beneficial. I think there is also a need to implement new tool sets. So if you are going to operate in this space, then you're going to need to be able to screen the wallets of your customers. You're going to need new tools for your investigations. So you need blockchain analytical tools. And I think this is where technologies like machine learning or artificial intelligence can potentially be quite valuable in tackling these new data sets and identifying areas of suspicion or areas of concern. But overall, I think my view is there's immense opportunity. So I think there are challenges, but there are also really significant opportunities in the digital assets area and in blockchain more broadly. So I'll just mention two. The first one is an advantage for financial crime. There's certainly financial crime professionals seeking to prevent financial crime. So there is sometimes a perception that still exists, probably less frequent than it used to be, but that still exists, which suggests that digital assets, virtual assets are a hotbed of financial crime. But they're anonymous, they're untraceable. In fact, blockchain offers a lot of benefits from a financial crime perspective. Transactions on a blockchain or like a public blockchain are publicly accessible. So, you can see the wallet, which is similar to a bank account that it was coming from and where it's going and where it went next. And that's actually quite advantageous compared with traditional financial transactions, where typically sharing them between institutions is significantly restricted. So being able to have access to that level of data is very valuable. It's true that it's pseudonymous in the sense that it doesn't readily connect with real world identities, but there are investigative techniques that can be used to solve that, and reputable exchanges will have that KYC information available if it's required. So I think from a financial crime fighting perspective, there are actually some real advantages with digital assets in comparison with traditional wire transfers and particularly with cash. And I think looking more broadly at blockchain, and the benefits that it can offer for us as a community. We see things like smart contracts being possible. They remove intermediation. They provide greater objectivity. So an example would be like an insurance contract, like an agricultural weather type insurance contract. So a farmer takes out that contract. It's embedded in a blockchain. It's linked with a reliable data source. So as soon as an adverse weather event meets the criteria, that farmer gets a payout, and they get that more quickly and with less interference from intermediaries than they would otherwise. So I think it offers immense benefits. Obviously, that's a community benefit rather than a financial crime one. But I think what that means is that we need to find solutions, as we're doing in this community and even on this call, to address the financial crime concerns, because overall the opportunities and benefits are significant and worth solving those problems.
Thank you, Catherine. Thank you, Elizabeth and Andrew, for your forward-looking insights on these emerging challenges. And we can see that it's really important to stay ahead in this digital assets field. So we're going to move on to our questions. We have a few questions from the audience. So there's a question here from Duncan. So this ties directly to the first part of this session where we talked about the 3 lines model. So he's asking, if this is the expected process, is this model the most effective? Are there new models coming on stream or being explored, for example, more automated and perhaps AI enabled? Would anyone like to take this?
I haven't. I can jump in. I haven't seen kind of a different model here. I think while technology and AI is great and can help teams execute their responsibilities more efficiently from roles and responsibilities and determining who owns risk. I think that's still something that's going to be done, at a higher level, and this model seems to have proven to be an effective way to do that. So to answer the question, I haven't seen kind of an AI version of this.
Yeah, I would agree. I would say this model may not always be the most effective, but it's definitely a good starting point. And I haven't seen anything that is like completely revolutionary different from the 3 lines model. So my viewpoint would be we start with that and adapt it. Certainly new technologies can help. They can help in any of the 3 lines or between the 3 lines. But I think that segregation between, the sort of standard setter in the 2nd line, the risk owner in the 1st line, and that independent oversight in the 3rd line, I think those are still required functions, even if they are supported and enabled by technology.
And the one thing I might just add to that, because I agree with what the other panelists said, is, there's in the risk discipline, there's other models that are used. There's sort of like the 5 lines of assurance. Again, old, nothing new, nothing too exciting. But again, under that model, it's very much, it looks a lot like the 3 lines of defense, but it also includes things like, tone at the top and the importance of board oversight and the importance of having, that tone at the top being set for compliance. And I think that's something that actually historically digital asset firms have struggled with, is having that appropriate governance. I think Andrew said this previously. And so I think actually going back to the old disciplines that we see in traditional banking, as unexciting as they are, is the thing that's going to move the needle in terms of compliance, especially for the centrally managed firms. And the only other thing that I would add on the AI piece is I have seen, especially for startups, AI can be a pretty helpful thing when it comes to things like first level alert clearance and things like that. But I think that where it becomes tricky is from a regulatory standpoint, you really have to have a good defense for how you set your thresholds and how you're managing your program. So, AI is not a panacea for everything. You still have to, do the work. You still have to have the appropriate resources, and you have to be able to justify how you've set your systems and thresholds.
Thank you, Elizabeth. So we have another question from Theophilus. He's asking, are there any guidelines or body that checkmates if this 3-line model is being followed, since influence and unclear duties between 1st and 2nd lines can be an issue?
So I can make a couple of initial comments on this one. So the 1st line and the 2nd line, this is like starting with the tone from the top and establishing a compliance program. And part of that is setting out the organizational structures, which includes the 1st line and the 2nd line, and the reporting lines that follow from that. So, for example, I think Andrew might have touched on this, that having that segregation independence is really critical. For example, if you had a compliance team that reported into the sales team, that would be a flawed organizational structure. So the compliance program is setting out from the top how this will work. Who sets the standards, who can approve them, if there's a breach of those standards, who has authority to respond, what remediation is required. The 3rd line is that oversight function is really part of the internal checks on whether that 1st line and 2nd line are being implemented effectively. If you see various kind of control failures or issues, like clients being approved that later have significant risk factors, those would potentially be indicators that the 1st and 2nd line are not being implemented effectively. And looking outside the institution, at least for regulated financial institutions, they will go through a regulatory approval or licensing process, and their business model, including the 3 lines of defense, would be part of that regulatory evaluation. Ultimately, if things don't go as expected, then that's often where an enforcement action might come into play. But obviously, that's the worst case scenario when things have failed already. So it's really about establishing that compliance program right from the start, the responsibilities, the reporting lines, and embedding that in the actual culture to make sure that it is implemented in reality, not just on paper. Elizabeth and Andrew might have some points to add on that one.
I would just add that I think as well, an organization's board is responsible for what I'd say is effective challenge and oversight over the program as a whole. And so, if there are failures at the program level, the regulators are also going to look at whether the board was properly supervising and providing that oversight to the compliance program. And so that's another kind of check on whether the model is being adequately implemented.
And the only other thing that I would add, and I think Catherine touched on this, is just not just during the licensing process, but throughout, regulators are responsible for supervision of the entity. So they're going to be undergoing periodic examinations. During those examinations, they will be looking to see that segregation of duties is in place, that they're going to be looking for things like undue influence, and they're going to be writing up entities if they fail to have those controls in place. So through ongoing supervision, that's another way through which there's a check on whether the model is in place and whether it's being implemented properly. And then throughout, even when you're not being examined, you still have your audit function that is presumably playing that role too, and is looking for things like, are policies and procedures being followed? Is there appropriate, oversight happening? So I think there's ongoing monitoring in place as well.
Thank you for these answers. We have some more questions trickling in. So here's a question from Theophilus. He's asking, while digital assets in some ways exist in the ether, how should players in the VASP markets orient their programs in order not to fall foul of regulators?
So I think what I would say is a good starting point here is to look at, for VASPs, to look at traditional financial institutions. Might not be that exciting for perhaps a fintech to be looking at a big bank as an initial model, but I think the compliance programs in the larger financial institutions are fairly tried and tested. They're a good starting point, and they can adapt from there. And the other relevant source of information are the regulators in that jurisdiction or in other reputable and reliable jurisdictions. So, what do they look for in their compliance program? And I think those would be a couple of good starting points. And as we've discussed, I think throughout this, there is a need to adapt that potentially. But the traditional kind of regulatory approaches are perhaps a good starting point.
We have another question here. I think this is from Mitch, saying he's asking, given that regulation and supervision differs in different jurisdictions, while digital assets in some ways exist in the ether, how should players in the VA? Okay, no, I think we just took that question. Just going through some of the questions here. Right. Okay, we have a question from Theophilus. He's asking, Elizabeth mentioned that the amount being already hacked by North Korea via crypto is alarming. Wouldn't it be proactive to also work side by side with counter-hacking programs that can stop the hacks while also working on regulating digital assets?
Well, I think I'll take this one. So I think one of the things that we already see in place, because the hacks that occur is typically a vulnerability being exploited at either a decentralized exchange or some type of social engineering attack, or a bridge exploit. So I think one of the most effective things is ensuring that there are consistent code audits and ensuring that there are bug bounty programs, for example, to incentivize, I think this is what the question is getting at, to incentivize like white hat hackers to identify issues before they can be exploited by bad actors and illicit actors. And a lot of that is actually, credit to the crypto community for doing this. A lot of that is community driven efforts rather than explicit regulation. I think that from a regulatory perspective, there is a lot of guidance already out there in terms of, cybersecurity risk and protecting against vulnerabilities. But as we've seen, just last week, these things are not foolproof. There's always going to be challenges. There's always going to be issues. So again, I think a lot of this goes back to, good risk management practices, good governance, making sure especially that you're educating your staff, because most of the time, as sophisticated as these techniques are, most of the time, I recall reading this recently, that Lazarus Group is not getting at, these things through very sophisticated methods. Sometimes it's something as simple as a social engineering attack on one individual that has been, spearphished or targeted, that allows entry into a system. And then that's how an exploit happens. So I think a lot of this goes back to basic risk management, basic education of your staff, more so than even regulation itself.
I would also say, I think this highlights the need for strong public-private partnerships and global coordination in order to deal with these types of issues, given the seamless way that digital assets flow across borders.
Yeah, and I think I would agree with Andrew on that I think there are already a number of public-private partnerships, not just focused on financial crime, but focused on, cyber as well, and interactions then between the different public-private partnerships. So we're not operating in a silo of, this is a financial crime one, this is a cyber one. I think they do exist, certainly in some jurisdictions, and they are working effectively together. Definitely scope to expand that, I would say, to other countries and other subject areas as well. But I think the point is spot on that the collaboration is necessary to face some of these shared threats.
Thank you. A very, very big thank you to Elizabeth, Catherine, and Andrew, and thank you to our attendees. And we really appreciate you sharing your invaluable insights with us today. Thank you again to everyone that joined us today for your questions and your engagement. And we're sorry we can't take any more questions because we're short on time. But please look out for our next webinar in September, which is going to focus on the AI edge, transforming financial crime compliance practices for financial institutions. After this webinar today, you will receive a follow-up email shortly with the recording of today's session. And we invite you to stay connected with us on LinkedIn and our website, which is finintegrity.org. Thank you all so much once again for your time today, and we hope to see you soon at our upcoming events.